Welcome to Informed Investor. After unveiling her 7th consecutive union budget, Finance Minister Srimati Nirmala Sitharaman sent shockwaves through the Indian stock market. In a move unexpected by many, the Finance Minister unveiled changes to the capital gains tax structure impacting both short-term as well as long-term investors. Additionally, removal of indexation benefits on property was announced. So let's dissect these changes and understand their implications for your investment strategies. First up, let's understand the announcement. Holding on to the agenda of simplifying and rationalizing capital gains, Finance Minister surprised everyone and announced that going forward, short-term capital gains on specific financial assets will be subject to a tax rate of 20% and increase of 5% from the previous rate of 15%. On the other hand, long-term capital gains for all assets will attract a tax of 12.5%, up 2.5% from the previous rate of 10%. To add some kind of respite to small investors, the exemption limit for capital gains has been raised to 1.25 lakh annually, a significant increase from the earlier limit of 1 lakh rupees. If you're still a little confused, let me break it down for you. First and the most important is the holding period of assets to determine whether you will attract short-term or long-term capital gains. Now, if you look at the listed assets, stock, equity mutual funds, bonds, REITs, gold, silver ETFs, if held less than 12 months, will attract short-term capital gains of 20% and increase of 5% from the earlier 15%. However, debt funds, non-equity mutual funds, overseas funds of funds and gold funds will be taxed at the applicable slab rate. On the other hand, long-term capital gains has been increased to 12.5% from 10% for all listed assets except for debt and non-equity mutual funds. Now, if you hold unlisted assets, it gets a little different. Holding period for all unlisted shares will be 24 months. Holding for a period more than 24 months will attract long-term capital gains. For real estate, unlisted bonds and stocks, physical gold and foreign scrips, short-term capital gains will be at the applicable slab rate. A highlight is for unlisted assets. The long-term capital gains will be a uniform rate of 12.5%, a decrease from 20% except for unlisted bonds. I'm sure you are seeking clarity on property sales because there was a significant announcement regarding the removal of indexation benefits. Before we get into that, let's understand indexation. So basically, indexation allows adjusting the purchase price of a property for inflation when calculating capital gains. So indexation ideally and effectively reduces the taxable profits. But without indexation, the taxable income from long-term capital gains increases, leading to higher tax liabilities for investors. Every fiscal year, the Income Tax Department publishes a cost inflation index to be used in calculating indexation benefits. The image on your screen shows the CII rates for different years. By multiplying the original purchase price with the relevant indexation factor, you arrive at an inflation-adjusted purchase price. Now let's understand this through an example. Suppose you purchase a property of 30 lakh rupees on 4th Jan 2010. Assuming a minimum appreciation of 6 to 7%, you are planning to sell it at a sale value of 70 lakhs. The indexation allowed it to arrive at an inflation-adjusted rate which is 65.2 lakhs. Hence, the capital gain arrives at 4.79 lakh rupees. With a 20% tax rate, you will end up paying only 95,808 rupees as capital gain tax. Now, taking into consideration the flat rate of 12.5% of the property sold after 23rd July 2024 and without any indexation benefit, you will end up paying 5 lakh rupees as tax. So all in all, an excess tax of almost 4 lakh based on our example. Now, what could be the impact on the real estate sector? According to the Director of CRISIL Ratings, the impact on the real estate sector is expected to be mixed. While the reduction in tax rates to 12.5% will boost investments in the near term, removal of indexation benefits will increase the tax, especially on older properties. But otherwise, there could be some other factors at play as well. Firstly, since the tax outgo is going to increase for old properties, the seller would transfer this extra burden onto the buyer, thereby making the property transaction more expensive. Secondly, buyers could opt for more cash deals and reduce the property value on paper. However, the stamp duty will be paid on the guidance value, which is regulated by the Department of Stamps and Registrations on factors like land area, location, amenities, and property type. Lastly, taxpayers could witness a shift in their investment towards infrastructure bonds. The capital gain amount, if invested in capital gain bond, can provide a tax saving option instead of paying excess taxes. However, this comes with a lock-in period of 5 years. To conclude, while the above proposals on capital gains result in some kind of simplification, there are far-reaching implications. These include higher tax rates for both long-term capital gains and short-term capital gains. If you wish to know any or seek clarity on any other announcement, do let us know in the comments below. Having said that, this is me, Ralson, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.